Good morning, ladies and gentlemen. This is Brad Matheny. Today is March 3rd. This is the custom index video, the MENT.com custom index video. Please, as you are taking a moment to understand what I am delivering to you, please take a moment to visit my website, MENT.com, understand what I do, why it's important for you to understand the opportunities that are being presented in the market, and understand all of the resources and tools that I deliver to you right now, and why you need to come in and try to support me with my research. The Expert Growth membership delivers everything to you. It's a very incredible service for you, for swing traders and day traders. It's very inexpensive for you, and I believe it is worth your while to continue to support me if you enjoy getting these types of research. Okay, let's go back over here to the SPY and take a look at what's going on. Now, I had been updating you with regards to the SPY. We had entered into a flag formation. I had indicated the potential for an A, B, C, D, E formation to the upside. In fact, let me try to draw that. A, B, C, D, E type of formation that I believed was going to take place. I warned that flag volatility is very likely to occur. Flags can be very violent depending on what happens in the markets and what happens. Normally, this type of a downside flag expansion is normally resolved within 4, 5, 6 days and rolls back to the upside. In this particular case, we had a larger downside decline followed by 2 sharp up days over here. And I want you to understand that this puts us pretty darn close to moving back into the range of the flag. I've highlighted these boxes down here, this area here and this area over here, which I believe are key support levels. We've blown through those levels down here to the 393 level, and then in 2 solid days, we've rallied back up into these support levels, these blue lines in this green-yellow box. It seems to me that this is a large washout or flush out pattern. It seems to me, and I'm going to try to prove it to you right now, that we have moved into a dynamic which is almost a repeat of the downside type of move. Let's see, from here to here. Very, very close. It didn't come down to this area. It looks like it came down right into this area. So kind of a double move. We had this move here to initiate the flag, followed by the rotation, followed by it looks like 100% move down into this support area, and we have rolled back up. I would not be surprised to see the markets move into this flag area. Try to draw a box to show you. Move back into this flag area, trying to find support in early March. Try to make this as light as I can. And try to make it light green. I would not be surprised to see us move back into this light green area, the flag apex formation, over the next 2 or 3 days, possibly Monday, Tuesday, getting a big pop. Possibly, I'm not telling you it's going to happen, but I would not be surprised at this point to see this support level hold, rally back up into this area, possibly through it up into the 420, 425 area, like I've shown back over here. As you can see right in this area, seeing this market move kind of like this, rallying back up, stalling out, and then moving up into this zone here by the middle end of March. And I believe that could be, let me try to redraw that. So it would be more along the lines of a rally up, stalling, rally up, stalling, rally up into this area, possibly reaching some peak here between the early portion of April and middle portion of April. And this would complete a very solid wave 5 move to the upside. So understand that, if we look at this from a standpoint of this bottom here, we have, and I've drawn these many, many times, but let me draw it again in yellow, bottom here, following all the way up to wave 1, wave 2, wave 3, wave 4, and now a potential wave 5 to the upside. We shall see. Wave 1 here seems rather long, so this may be kind of a scenario like this. This may be a wave 1, 2, and then we have a broad A, B, C, which makes more sense, than D, and then an E. The reason behind this is that wave 3 would be here to here and would be the longest wave. So understand that we have a scenario setting up in the markets where continued strength of the U.S. dollar, continued strength of the U.S. equity markets may continue to surprise us, and we may be looking at 420, 425, 430 before we get to this next peak area. And this is going to happen probably likely somewhere in early to mid-April. Okay, let's come back over here and take a look at the chart, and you can see this is a broader flagging formation that I set up with the zones of support. You can see this blue line. Let's see where this blue line originates. Looks like it goes quite a ways back. Let's see where it goes to. It's one of the benefits. My charts may look like spaghetti to you, but where did we just bounce off of? We just bounced off the low support level from 2009 through 2010. This blue line carries all the way across to provide additional support right here. Look at how beautiful that is. Oh my gosh. So spread this out. There's that same blue line right there. That's the low support level right here. Low support level from 2010, 2011. We just bounced off that low support level from 2010, 2011. You can see we bounced off it over here as well. Came below it. And you can see we got below it back over here. So we've tested down in these lower channels in October. And looks like we tested it briefly back over here in June. Rallied back above it, broke through it, came down, tested the high channel. This is the dashed line here. The high channel came back up, broke below the low channel again briefly, came back down here and held. Very strong support, ladies and gentlemen. I don't know if you understand this, but this is the high channel support. This dashed green line right here is the high channel support from 2009, actually 10, 11, 12. And this is the low channel support from 2010, 11, 12. So when we take a look at this from a standpoint of where are we just confirmed the high channel support from 2010, 11, 12, and we reconfirmed the low channel support from 10, 11 right here. As long as we stay above these two lines, this line here, this dashed green line, and this solid blue line, which I can change to a dash. Let's change it to a dash to make it a little more functional. And understand, as long as we stay above those lines, ladies and gentlemen, we are in a bullish trend bias. Now, we have yet to really rally out of this. The MENT rotational modeling system has moved bearish, which is fine because we are flatlining here. That moves us into a more hedged position. In reality, just like I've been telling you, we're likely going to move upwards into this 425, 430, 435 area right over here into early April. This is April 10th right here, 17th, and then 24th, and then we get into May. And I believe this is very likely the outcome. A solid, let's take a look at this, a solid 28-point rally in the SPY, which reflects a 7.18% move to the upside potential. And that means that we are looking at a new upside rally phase setting up, which will likely be wave 5 to the upside. It will likely exhaust to the upside. And you can see here how I've measured this. So we have this move here and then this move here. So this cannot be C. We cannot be in a C move here because A move is larger. We either have to get up here and then roll downward and then roll larger, or we have to get above this 440, 450 area. Unless this is A, the peak of A right here, then things make a little more sense. That would mean that A is here. And B is potentially, let me see if I can get this. Right there. So we would go A, B, and then A, B, C, D, E, potentially up to here. And that would be a C move, potentially. And then this would roll back down, which makes a lot of sense. And then we would have a D move to the upside. D, I think, is going to be rather substantial. I've drawn this to you before. Try to shrink this down. Oops. Get rid of some of these older lines. Get rid of that. And get rid of this because this is likely to not happen. And where we're at with D is, I think once we get up A, B, C here, we are going to have some kind of a measured pullback, maybe into this 408, 407 area, possibly down into this 393, 395 area, which would be a fairly strong pullback. So understand, we could have, an A, B, and then we could have an A, B, C type move here. That would be fine. That would be a broader A, B, C move to here. But then the pullback back over into here into possibly August, September, maybe end of July, August, will likely start a new upside trend targeting 450, 460, maybe 470 to new all-time highs. We do need to get back above this 410 number. We must close above 410 to see any type of upward trending. So be aware that 410 is going to be that magic number in the sign as we move forward in the markets as we move forward. And you can see I've got a lot of graphics on here, but again, I read it as what I see and try to give you the best interpretation that I can. Okay, let's go before I waste too much time into the custom indexes. Now, a custom index chart. This is, I got to resize it. Let's see if this works. Close but no cigar. Stretch it out a little bit. Okay, there we go. Custom core commodities index is flattening out. This is good. This means that inflation is weakening. Commodity price inflation is weakening. This will continue to stall out as we go through this, let's call it a reversionary price cycle phase. What is happening is we have gone through an event, the COVID event and the post-COVID event. We've gone through an expansion in speculative trading, and now we are deflating from that event. It takes time, ladies and gentlemen. We may see another 6 to 12 months, maybe 16 months of deflation as we head into the 2024 election cycle. But again, this deflation of cycle, we blew past this big bubble, and we're now back into this type of deflation trend. This is actually very, very good, okay? We want to see this happening. Takes pressure off of the Fed. The accumulation index is a monthly chart. We need to see the price of the accumulation cycle phase system staying below this blue line. This is healthy for an uptrend. This is the SPY. I believe we're going to stay in a fairly narrow channel until, like I said, August, September, October till we get into Q3, Q4 of 2023. So be prepared that we literally have 4, maybe 5 months of sideways trending within a fairly tight range, maybe 7% to the upside, maybe 7 to 9% to the downside, but we have a very tight, narrow range of probably 12 to maybe 14% range trading out through March, April, May, June, July, possibly August. You need to be aware that there's going to be a whole lot of go nowhere, more than likely, over the next 6+ months. Next, we have the cash flow index, the weekly cash flow index. You can see we have a bit of a bottom here. We're holding up quite well. We need to see this hold up above the 135 to say 155 area as this reflation upward trend happens. If we get some sort of an upward move, we'll likely see this 150, 160 area again. But I want you to be aware we don't want to be too high. That tells us we're moving back into bubble territory. Consumer Engagement Index. This is a monthly chart. It goes quite a ways back. You can see that we're back into early March with moderate weakness, general consumer engagement. We would like to see this hold up in this area. I've extended this purple line and this pink line. I think we're flagging out. So we've got maybe 3-4 more months here, maybe 5 more months. I think we'll probably try to be up in this upper area just above this purple line. I think this will really start, consumers will really start to return back in July, August, September, in my opinion. The devaluation cycle trend, this is an older chart, keep forgetting to delete it. The large cap index has moved up. This is a great sign. Remember, I had been warning about this as we neared the end of this cycle. This kind of a gold colored line right here. Moving off of a base and moving up the way we have is very early stage reflation. So you can see we've got the base, we've got it moving up. We need to see some upward trending. And if we do, we might actually see a solid little melt up. Maybe 2023 turns into large cap growth of maybe 11, 12, 15%. We will see how this plays out. Now, remember, large caps tend to react differently than the NASDAQ and other sectors of the market like the Russell. The reason being is the large caps are established, global, multi-asset types of enterprises, which will, during a contraction phase, they will react with the market, and during an expansion phase, they will react with the market. If we're at an early stage expansion phase, starting to get some upward trending here, we may see this carry over into a fairly strong rally phase through part of 2023 into early 2024. Like I said, I expect it more around August, September, October, though, of this year, 2023. Okay, the global asset index, again, 2 little white bars, good to see. Remember, February was pretty ugly earlier. We need to see this hold up as well. We're getting that kind of a basing, bottoming. I mean, it's not quite like this. It's a little more like this with an engulfing pattern followed by a number of months. But I need you to be aware that we could get, into kind of a sideways expansion. In other words, we're moving up, just not very aggressively. This was a move by the Fed to spark the economy, and this was a pullback that occurred. Then we changed direction. This was the election cycle, 2015-16. Then after the election cycle, we moved forward. So now we also had an election cycle, if I remember right, back over here in 2012, before the election. So be aware that we could see this start to move higher, maybe back up into the middle of this box. But we're in a major presidential election cycle, 16 or so months out. We could stay fairly sideways. And I need you to be aware that the upside, real upside potential of this may only be about 7 to 12% in the SPY. Gold custom cycle chart is showing again a bit of deflation or let's call it devaluation. We are still in that accumulation zone. So we had seen some accumulation here. We'd seen it accumulate back out. I think this last move down in gold has quite a few people not paying attention to it. And I think we're going to see a big move in gold. I think gold and silver could be the real stellar performers over the next 24 to 36 months. And when I say stellar performers, imagine the SPY stays within a fairly tight range, maybe 15, 16, 18% higher, maybe 7 to 12% lower, somewhere in that range. Yes, there's a range to trade, but gold could be trading at 4,500 an ounce in the next 2.5 years. It could literally double and or more. So be aware that once we end this accumulation phase down in here and we actually start to see price appreciation, we could have a very big move in gold and silver that no one's really paying attention to. And that could come with some sort of a global market crisis event. Could come from just about anywhere. But again, we are seeing gold hold and accumulate. Let's see how this plays out. This would be a really good time to start accumulating bars and coins if you can, in any size, shape, or formation. Next, the innovation index. We're back up in the early channel cycles. Remember, this was COVID, the beginning of COVID. We kind of broke out. If you look at the range here, we kind of broke out in early or late 2019, reached a peak, COVID hit, then we saw this big, massive, just speculative bubble take place. Then we peaked in 2021, double peaked. I mean, you can call this a double top. It doesn't meet my criteria as a double top. But then we rolled into this extensive devaluation phase. Now, we do have a channel. You can see it kind of across this line coming down here. We need to be aware that we could see continued revised downward earnings over the next 12 plus months. Now understand, like I mentioned to you, Apple. Okay, Apple comes out and they revise their earnings down 10%. So they don't make $2.8 billion a year. Now they make $2.55 billion a year. The long and short of it is downward earnings are to be expected in this market as we move forward. Technology is still, in my opinion, a very solid sector. I think mining and metals are going to surprise everyone as we slide into 16 plus months of sideways trending. And we'll see where we're at with 2024. But hold your horses on these index technology sector right now. We're kind of near this peaking level. We could roll back down a little bit, maybe 7, 8, 10% as we move into earnings and revised earnings. Remember, the cycle has to play out. The devaluation cycle has to play out for prices to be able to base, bottom, and attempt to accumulate or appreciate again. So until we get a real big change here, this looks like kind of a pullback in a downtrend, maybe trying to move a bit lower. I don't think it's going to get to any extreme lows here. We already had an extreme low down here. We could easily, though, pull back down into this 60 area, which would be about an 8 or 11% drawdown in technology, forming a base. And again, the base is likely going to come in the form of revised earnings down to a point where they will not be revised any further to the downside because it's finally reached a stabilization point, and now we're going to start to see an appreciation cycle, a growth cycle again. Okay, the fear index. Fear is back down to 6.23. Very good to see. We do kind of want this to move back down below the 6.0 level. That would be great to see. The SPY is above the green line here of the super trend index, and the custom market sentiment index is doing exactly as I predicted, flatlining down around this upward sloping channel, this median dark brown area here. This is actually good. This is a good basing bottoming formation. You can see we ended our downward cycle here, moved back into an upward cycle here. This is essentially hammering out a bottom, folks. That's exactly what this is. The sentiment index, the SPY, and the fear cycle are hammering out a bottom. The more we stay away from these fear events, the more likely we're going to move into some sort of a hammering out a bottom mode. You notice how we hammered out a bottom here and then moved into appreciation. Kind of done the same thing over here. It's taken about almost 8 months now, and this took almost a full year. It took about 10 months before we started appreciation. We may have another 3-4 months to go before we start some real appreciation, and that lines back up with my August, September 2023 range for an upward move in the markets. But again, we are really attempting to hammer out a bottom here. That's what it looks like to me. Okay, the real estate index is again back up near extremes. Watch my real estate video this week. I mean, this is really wacky. I don't know how to explain it. Home prices are holding up. Sellers don't want to sell at a cheaper rate. Buyers are very, very cautious right now. I see this whole thing as another potential house of cards. I see that we have to move from this extreme hostile area back down into this more neutral, opportunistic area in this lower green-blue area. And I believe that the house price levels, this is what you're seeing here is average U.S. house price. I believe that needs to move down into this 310, 320, maybe 270, 250 area in the process. So unless the Fed, really surprises us by dropping rates to 2% or 1.5% sometime soon, I believe this whole deck of cards is going to start to unwind with a moderate, not a severe, not a crisis, but I believe it's going to be more of a moderate 70s style price decline, meaning, maybe -10, -12% a year. Going forward, that would put us from hypothetically the 400 mark up here, put us down to if I do the math right, 360 1 year, and then potentially down to 310 or 320 the next year, and then potentially down to 285 the next year, and then potentially bottoming. So understand this could be a 3 or 4 year process of unwinding excesses in the real estate market. But we are seeing here, this is really, look at this, folks. We've never seen anything look this hostile in the housing market in the last 25 years. That means that we are in new territory with regards to pricing, inventory, affordability. I mean, this, like I said, something's gonna break. I'm just waiting for it right now. Okay, the monthly tech ratio index, February was fairly ugly. We're floating around this bottom area. Would love to see this continue to hold up. We could see kind of a scenario like this. Remember, 2015-16 was an election year as well, until we got into 2017, where we actually had, a bit of a rally phase, followed by the 2019 downside move, followed by the 2020 COVID spike, the big bubble. We could be in this pre-election phase, kind of like this, where we could stay sideways in this tech ratio index for a number of months, and understand that we've seen a big growth factor. We've seen a big growth factor after COVID, whereas everybody was cash rich, everybody was buying their streaming services and what have you and using Amazon. Now with the higher interest rate environment, we could see this flatten out, stay below this 37, 35 area for another maybe 15, 16 months. So be aware that technology is going to provide some opportunities on some decent bounces, but you need to be very cautious. It could turn into a widowmaker on you if you're not prepared. Again, I think we're going to just kind of flatten out over the next 6 to 12 months here. We'll see what happens. U.S. to global market index, okay, we rebounded last week. You remember we had come back down. The selling pressure was fairly extreme. I indicated that I thought the U.S. market would try to hold above these pre-COVID highs or these lows over here. I indicated that the global market would try to hold from above these COVID lows back over here. We are seeing a bit of an upward trend. Even though the MENT rotational modeling system has moved down into a bearish trending mode for the daily chart, still bullish on the weekly SPY, I believe we're flagging out here. We're moving into the extended sideways flag, just like I predicted on the SPY chart at the beginning of this video. We need to see how this plays out. Ideally, I really think March is going to be quite strong. It's going to lead into an April 7th to maybe 15th, 18th peak. and then we're going to roll over into kind of a sideways slide, ending possibly in early mid-June or at the latest maybe July 4th through July 10th. And then we're going to be basing bottoming and starting to move into our August early rally phase. That's the best advice I can give you. U.S. Custom Valuations Trend Index, again, showing some real weakness here early in March. This is to be expected. As this flattens out, we are probably going to see some dramatic change. It may come in the form of some sort of an upside move here in March. It may actually move a bit lower down here into April, May, June before we get a bottom. But at this point, we do not see real appreciation in the U.S. market. So that's telling us that we are still searching for a bottom. We do not have a confirmed bottom yet. We do not see the broad market cycle trend moving higher into an appreciation phase. We are still in a depreciation phase. We are essentially revaluing, trying to find a bottom still. Would love to see this form an engulfing bullish like we saw right here or right here and set up some sort of a major bottom, but we're not there yet. We'll see what March brings us, see if we get a big engulfing bullish. If we did get something like this or like this, it would give us a pretty good indication that the lows of August or October or so of last year are the bottom. That's it. We do not have any much more downside unless we have any type of a crisis event. Next, we have the leading index. Leading index is stalling out a little bit in this channel. This could go kind of either way, ladies and gentlemen. We could see a little bit of a downside move here, could see a little bit of an upside move here. I think March is going to lead us into, particularly after March 8th, 9th, 10th or so, we're going to move into an upward trend. So this next week could be kind of mixed. Could be up a little bit, could be down a little bit. We're in this upper channel. We could retest these lows around 2 and see what happens. And then, like I said, when we get into March 13th through the 31st, I think we're going to see a fairly solid upward move in the SPY. The volume ratio index shows we had quite a bit of volume last week. Nothing really to be concerned with. Not anything like one of these big spikes, which would indicate selling or buying pressure. But again, traders are, engaging in this market. They're taking positions, expecting to see what's happening next. And I believe, like I said, we're in for a pretty decent melt up. Commodity to gold index moved back above this channel again. This is again a ratio of gold to general commodities. So this is going to tell us where we're, how we're seeing gold react. So understand that certain commodities might be a little higher. Gold was a little bit higher this last week. We definitely needed to stay down in this lower channel, this lower red deflationary channel. I think that's going to be what's coming next. But it may still be, this is a weekly chart, it may still be, 2, 3, 4 months away of staying down in this lower channel. Okay, the metals trend index, this is gold starting the next impulse wave up. I'll give you a brief hint. This is targeting 2100, 2200 on the next phase up. There's a 4,500 point rally here that takes place very regularly. You can see it from this low to this high and from this low up to this high up here. This next move, if it does the same thing, is going to put us up into the 1450, 1350 to 1450 area. That's way up here. We're currently back around the 1150 area. That's about a 2,500 point rally phase up into this area. Now, what would that mean for gold? That would mean about 2250, 2270, right in that area for gold. And again, this is a weekly chart. It could happen fairly quickly, but I'm guessing that we're going to be in or around the 2150, 2250 area, probably sometime around November, December of 2023. And then we will pause, okay? We always have our little pauses before we get into the next rally phase. So once we get up to this 1350, 1450 area, we will pause, probably come back around the 1960 area, find some support, and then rally back up And that next phase is going to put us up into the 2750, 2800 range on gold. Fangs still holding up right around this mid channel. Very, very likely, ladies and gentlemen, that Fangs over the rest of the year could move back lower and enter into multiple basing bottoming waves as the expectations with regards to earning an economy kind of settle. We've gone through this huge expansion phase, speculative phase. We've come back down into lower channeling. We are moving to the upside. We could see it kind of blip. And these blips can be very dangerous if you're not prepared for them. They could be literally 12 to 20% downside blips in price on missed earnings or on missed subscribers. The long and short of it is we are not out of the woods with technology. Technology tends to do really, really well in a lower interest rate environment where consumers are actively engaged. We have a higher interest rate environment and consumers still pulling away. Technology may be in for bouts of contraction, so be aware. The metals chart index, there again, there's our capitulation bottom. And now, like I said, we're moving back up into this area. This is going to be 2100 roughly, maybe 2200 up in this area. You can see this big solid move. This is basically half of the move. So if you imagine this move extended up to here, that'll put us right around 496, 497, maybe a little higher. And that's the next big move coming for metals. Now, where is this fear cycle coming from, driving metals higher? It's coming from likely a warning or a fear of global market credit event cycles. So understand that we're likely looking at a potential global market credit event cycle, and that's what's driving investors and traders to move back into metals. Remember, the Fed is pushing interest rates higher. It has that eerily reminiscent scenario of 2004, 2005, when Alan Greenspan was pushing interest rates higher, trying to normalize interest rates. And then, of course, remember, it was about 4 or 5 years later, the housing market kind of imploded. I think the entire cycle is much faster right now. I think the COVID blip has caused us to move into a hyper cycle with regards to how this is playing out, which means this move in gold, which would normally take 7, 8, 9 years, may take place over 5 or 6 this time. It may be a very big, quick cycle. Smart cash index, we kind of looked at this earlier. We're holding up. We're back above this gapping formation. We have reached a new high here above this high level and above this high level. We do need to see this hold up. And this is the low near the COVID low areas that I talked about on the global markets. This is the global market smart cash index. We have rolled over. We have traded. I do believe we're going to try to get back up above this level near October, November, December. But in the meantime, we have a lot of sideways room over here to meander and try to find our base. This also gives us a fairly clear picture of an A move, a pullback, and then potentially an A, B, C, D, E, maybe before the end of the year, and then some sort of a pullback, and then 2024 moving into a D move to potentially move higher. And remember, that could just be wave 1 to the upside. Okay, the MENT rotational modeling system is, I'll roll this down. Bullish on the weekly and bearish on the daily. This means that we are net in our one account position, bearish 50% and 50% cash. The way this works is, again, it's a weekly modeling system with 25% allocation and a daily modeling system with 75% allocation. This recently rolled into a new bearish trigger on February 4th. It is up just about 2% right now. May not last, I'll tell you that. It could roll back into a bullish position, but this is fine. We're holding up very, very well. Let me come over here and show you. We're holding up very, very well this year and last year compared to the SPY. we're at almost new all-time highs, and if we get a good trend out of this, we'll probably be at all-time highs again within the next 3 months or before the end of this year. You can see the quarterly performance has performed extremely well. You can see we've had a couple of drawdowns. Last year we had a drawdown of about 5% in one quarter. It looks like it was early 2022, first quarter. And I need to update this. Oh, I have. So far, we are off 1% this year. Nothing serious. We are looking at, again, equity allocations have not changed. I checked all the charts this morning. We are looking at 25% allocation for stocks in our primary allocation levels, 50% cash because we are in a bearish daily trend mode, and we are 25% metals. We have been hedging metals for many years. This is a great hedge right now. Cash is a secondary hedge. Stocks, like I said, you need to wait until July, August. The real opportunity comes July, August, September for the next phase, in my opinion. This little move up in March that I expect will be good for short-term traders. But remember, it's only going to last about 25, 35 days, I think. Then it's going to end. Okay, remember, look up my MENT rotational modeling system and real estate update. We'll come over here. Okay, here's the real estate. Real estate, just briefly, has gone into new dynamics. Much higher reductions, much higher days on market, much higher inventory. Demand has really stalled. You can see demand is the orange line here. Price factor is at minus 22%. Real factor down 1.131% last week. Demand cycle is a little bit higher. And this is a normalization of demand. Look at where it's at. Okay, it's up in the 20% area. It was up in 120% area. We've gone from 120 down here to minus 40. We've reverted back over here kind of to a normal flatlining because nothing has changed in the market. We've seen this demand weaken and then kind of just revert back into kind of a middle area. I believe this is going to all start to really tank. And I'll explain to you why here as we move over here. Price reduction activities up at 150%. Real estate active listings are in a downward cycle again. This is telling you that you get flushes of new inventory, and then we get into that inventory sits for a while. You can see the new count metrics have gone up. Days on market have gone up as well. Pricing factor, price trends have pretty much flatlined here. I think we're going to get into a downward pricing cycle. And then next we have the more in-depth. Heat rank has turned negative, keeps inching its way downward, minus 8, minus 7, minus 6, popped back up a couple of weeks ago. Move this up. And then now it's starting to move back down again. The tightness rank has fallen to minus 100%, pulled back to minus 60. This is a very key metric. This is telling you that essentially the bottom is starting to fall out of the market. We're not seeing the heat rank stay up in these positive territories now. Now we're going into new waves of what might be downward cycle trending. Real estate inventory strength has done the same thing. It's gone from positive wave cycles to flat line to kind of a recovery phase to a new negative market cycle to kind of flat line, and now we're heading downward again. Inventory strength measures the core value of the total inventory related to price activity. And again, we get seller desperation has started to pop. When we get these little spikes in seller desperation, this is telling you that, you know, new waves of price declines and new waves of sellers trying to dump their property are taking place. So we've had a couple of big changes over here since January 2023 with these spikes in seller desperation. This was about 100%, like 94%. This was 126% last week. You can see it's fallen now 141% to get back down here into this negative territory. This means we're not seeing a lot of seller desperation right now, but I think it'll pop back up. Okay. Next, the U.S. stock market weekly chart, where you can see the bottom. You can see the ABC wave, the way I'm counting it, which may actually be kind of an A. Well, actually, this has to be the C because, or the B because it's a lower low than this low over here. but this is a custom index. So this is why it's important to see these as variant chart types or setups. We are above this downward sloping channel. We are holding kind of above this middle channel here, trying to form a bottom. We still have some downside risk over here, which I think is going to come in April. So the next phase is likely to come back up into this area, up right near this arcing level right here, reaching a new high, potentially getting up above this level briefly, and then rolling over into a pullback in April, May, June, possibly starting a base bottom in July. So everything's playing out just like I told you guys. Actually, it's really impressive how my analysis throughout all of this base bottom and through this move here has actually been pretty darn accurate, I have to say. I was calling for a bottom back over here, possibly an ABC bottom. Then we had this deeper low take place. My systems were short through this entire time frame, then started to get long back over here. Now we're back into a daily short on the MENT rotational modeling system, looking for a rally phase back to the upside. So again, we're in that March rally phase. So get ready for what I think is going to be fairly decent earnings, and we'll go from there for Q2. Then we may move into Q3, which might be a bit difficult. The evaluations chart, like I showed you, is staying down here near these lows. This is great. This shows that we're in a deflationary trend, a revaluation cycle trend. I expect it to stay here until we have some real growth phase set up, and I think that's more coming in 2024 and 2025. The custom volatility index spiked back up higher to 1151. I love this little chart. I don't know why. I mean, I know why, because I can read it, and I think I can read it fairly well. I do believe we're going to see some consolidation, some additional consolidation here. We could move to the upside, maybe up into this 1415 area. That would be considered extreme, fairly extreme bullish trending for where we're at, considering we're hammering out a bottom. Okay, what's more than really likely going to happen here, guys, is this type of a scenario. We enter a range. Maybe it's, maybe it's up here in the 12, 12 and a half, 13 area, and maybe down here in this 8 area. And then as we continue to attempt to hammer out a bottom and move higher, the volatility index will roll within this channel. Not really going too low, not really going too high, just roll within this channel as the market continues to trend. Now remember, once we get into the April timeframe, where I expect the market to pull back to the downside, we could see this roll all the way back down here into this 6, 7, 8 area, trying to reform this bottom before we move into the next phase upward. So again, we have quite a bit of opportunity coming. You just really need to be aware of the April through June, July downward cycle trend that I believe is still coming. And nothing tells me it's going to be any different. Okay, lastly, again, come back to, oops, wrong one. Where am I here? Yes. Come to MENT.com. Help me out. If you follow my research enough and you like what I do, please come in and visit the website and consider joining the Expert Growth membership page. It's really worth your while if you value what I'm telling you and you like the type of research that I give you, on top of all the other tools that are out there. Additionally, I'm getting ready to launch the new GT3 MACD system, which if you followed me on Twitter or Facebook, you'll know that the GT3 MACD day trading model is great for people that are intraday traders. It's designed to help you, and it's designed to help you make better decisions. As I started this service over the past 5, 6, 7 months, there have been a number of people who've come to me and said, well, your swing trading stuff is great, but I'm more interested in day trading. And I was trying to really avoid day trading because day trading requires a lot of hand-holding. And I don't necessarily mind the hand-holding, but understand my job is to continue to do the research and the coding that you require to develop better tools. So the real reality is I can't spend 10, 12 hours a day hand-holding and answering questions while I'm trying to write code at the same time. It doesn't work. So I've developed this tool, the TT3 MACD system, which I believe will be a very robust solution for day traders. And if you guys take it and play with it and use it and give me feedback, I will continue to expand upon it, making it better and better and better to help you guys become better day traders and use the tool efficiently to actually trade the way you want. Okay, remember, come to MENT.com. Follow my research, share it with your friends. Let's make some money in the market over the next couple of months and years. And like I said, all of this is because I have the skills to really create whatever I want. Okay, I can essentially get in, code, and create anything in a matter of weeks or months and refine it. I've got more than 25 years experience doing this. I enjoy it. What I'm trying to do is build a collective of individuals who value my research and can use it efficiently. You have to learn. It's not something you can start with tomorrow and start trading 2 hours later. You need to actually start learning and watching and learning to make decisions on your own. So again, come to MENT.com, visit and join the Expert Growth membership, and we'll go from there. On to the next video, guys.